Most trends hit like a whisper before they become a roar. And right now, one of the loudest roars in the American financial landscape started from a place almost nobody paid attention to. It wasn't a billionaire investor on CNBC. It wasn't a tech CEO unveiling a shiny new device. It was a footnote. Yes, a literal footnote inside a corporate report from a mid-sized manufacturing company in the Midwest. In that tiny line of text, the company quietly revealed something unusual. They were reducing water usage, cutting waste, and restructuring their supply chain to lower carbon emissions. And doing it not because activists demanded it, but because investors were suddenly rewarding companies that did. When analysts ran the numbers the following quarter, something surprising happened. This unassuming company had outperformed larger competitors, attracted new institutional investors, and increased its operational efficiency, all while spending less money overall. That small footnote turned out to be a flashing sign of a much bigger shift. A shift not driven by guilt, fear, or pressure, but by profitability. That's when Wall Street perked up. That's when billion-dollar funds quietly pivoted. And that's when the initials ESG, environmental, social, and governance, began carving their path into mainstream investing conversations. But here's the twist. While the financial world has been busy capitalizing on the ESG wave, most everyday Americans are still standing outside the door, unsure of what's going on behind it. Some think ESG is complicated. Some believe it's political. Some assume you need special accounts or a professional advisor to get started. Others have heard the term but don't know what it actually means in practical terms. And yet, the irony may be this. ESG investing might be one of the simplest, most accessible ways for the average person to participate in long-term market trends. Trends that are shaping how companies operate, how innovations get funded, and how value is created. Before we go deeper, quick disclaimer. Nothing in this video is financial advice. This is for educational purposes only. Make your own decisions or consult a licensed professional. Now, with that out of the way, let's break open ESG not as a buzzword, not as a political talking point, and not as a Wall Street strategy only for the elite, but as a practical roadmap that ordinary Americans can use to invest more intentionally, more intelligently, and potentially more profitably. To understand ESG investing, we need to strip away its reputation and look at its foundation. Think about the basic principles of investing. You are trying to put money into something that has the potential to grow. You want returns, but you also want reliability. You want companies that manage risk well. ESG is simply a structured way of evaluating how responsibly and efficiently a company operates, because responsibility and efficiency often translate into stability and growth. ESG isn't about tree-hugging or moral superiority. In its purest form, it's about risk management. Let's start with the E, environmental. At the simplest level, this looks at how companies impact and interact with the natural world. Do they waste resources? Are they energy efficient? Are they vulnerable to climate-related disruptions? Companies that operate wastefully or depend heavily on outdated processes may be at a disadvantage as regulations tighten, supply chains evolve, and consumer preferences shift. Meanwhile, companies that innovate on energy usage, waste reduction, and resource efficiency often reduce costs and improve resilience. Think of it this way. If two companies produce the same product, but one has lower energy expenses, lower waste disposal costs, and fewer environmental liabilities, which one is better positioned for long-term profits? ESG is partly about identifying that winner sooner rather than later. Next is the S, social. This category evaluates how a company treats people, their workers, customers, and communities. It might sound fluffy at first, but the financial logic is straightforward. Companies with high turnovers spend more on training and onboarding. Companies with poor safety records face higher insurance costs and legal risks. Companies with weak customer trust lose market share. By contrast, companies with strong workplace cultures attract talent, retain employees longer, and maintain customer loyalty. These factors directly affect profitability. Social considerations aren't about being nice. They're about operational strength and brand durability. Finally, there's the G, governance. This one often gets overlooked, even though it might be the most critical. Governance asks, how well is the company run? Are the executives accountable? Does the board prevent reckless decision-making? Is the company transparent? Strong governance reduces the chance of fraud, scandal, and mismanagement, things that can wipe out investment value overnight. For everyday investors, governance is like checking that the captain of the ship actually knows how to steer. When combined, these three pillars form a framework that helps investors identify companies built for long-term performance. ESG is not a shortcut to guaranteed profit. It's a filter for spotting sustainable business models designed to withstand economic shifts, regulatory changes, and societal expectations. But here's the real question. If ESG is so practical, why does it seem complicated? Why does it feel like an exclusive club with its own vocabulary and gatekeepers? Part of the problem is branding. The term ESG gained popularity among institutions, analysts, and asset managers before it reached everyday people. As a result, many think ESG is an advanced strategy. Another challenge? Different organizations use different scoring systems. ESG isn't regulated or standardized in a way that makes it easy for beginners. One rating agency might rank a company highly, while another ranks it lower because they weigh factors differently. But this complexity shouldn't discourage you. In reality, ESG can be incredibly simple to apply, simpler, in fact, than many traditional stock-picking methods. The key is understanding that you don't have to personally research every environmental report or track every governance metric. There are funds, ETFs, index products, and public databases that do this work for you, and many of them are designed specifically for people who want clarity and convenience. Before getting into how these investments work, let's talk about why ESG exploded in the first place. Over the last decade, global investment flows into ESG-related funds surged from niche to mainstream. The reason is not ideological, it's mathematical. Large institutional investors, pension funds, university endowments, insurance companies, and mutual funds manage trillions of dollars. Their job is to minimize risk while maintaining returns. When these institutions saw evidence that companies with strong ESG practices tended to experience fewer major disruptions, fewer lawsuits, fewer compliance fines, and higher operational efficiency, they moved capital accordingly. This wasn't emotional investing. This was rational investing. For companies, the message became clear. Improve ESG practices or risk losing investor support. As more companies adapted, the investing landscape changed. New funds formed, old funds rebranded, corporations started reporting metrics that used to be irrelevant. Suddenly, ESG wasn't a niche corner of the market. It was a major force shaping how companies operate. And yet, despite all this movement, the average person at home still wonders, okay, but what does this have to do with me? And that's where the story becomes interesting, because ESG investing is one of the few financial trends where everyday individuals can genuinely participate without needing high capital, special tools, or advanced knowledge. Let's break down accessibility. Many brokerage apps, Robinhood, Fidelity, Vanguard, Schwab, E-Trade, offer ESG-focused ETFs and mutual funds right alongside traditional ones. Often, the minimum investment is as low as $1. Some platforms even allow fractional shares, making ESG portfolios accessible to beginners who want to start small. These funds are managed by experts who analyze companies through ESG metrics, so you don't have to. You're essentially outsourcing the research to teams who specialize in screening companies. Additionally, many retirement accounts, including employer-sponsored 401ks, now offer ESG options. This means that people who don't actively invest on their own may already be partially invested in ESG through their retirement plans without realizing it. Another reason ESG is appealing to everyday Americans is that it aligns with a simple principle: investing in companies that aren't likely to collapse due to preventable mistakes. You don't need to be an environmental scientist to understand that a company heavily dependent on outdated, resource-intensive processes is riskier than one that has modernized. You don't need to be a sociologist to recognize that a company with high employee turnover is spending more money than one with strong retention. You don't need to be a corporate governance expert to see that a company with repeated scandals might not be managed well. Everyday Americans often make decisions about where to shop, which products to buy, or where to work based on similar logic. ESG investing simply channels those instincts into the financial world. Now, it's important to acknowledge the controversies surrounding ESG because pretending it doesn't exist would be misleading. Some critics argue that ESG is subjective. Others believe ESG ratings are inconsistent or influenced by politics. Some say ESG can hurt returns, while others argue it boosts returns. The reality is nuanced. ESG is a tool, no more, no less. It's not magic, it's not guaranteed, it's not inherently political. It's simply a way of evaluating companies beyond traditional metrics.
Like any tool, its effectiveness depends on how it's used. Some ESG funds are well-designed, others are sloppy. Some companies commit to real improvements, others engage in greenwashing, exaggerating their efforts to attract investment. Understanding this nuance helps you approach ESG with clarity rather than hype or skepticism. And that's exactly why we're breaking it down step by step in this video, so you can understand the landscape, the opportunities, the limitations, and the strategies that make ESG both accessible and potentially beneficial for everyday investors. Now that we've unpacked what ESG is and why it exists, the next step is learning how everyday Americans, students, workers, retirees, families, first-time investors can practically tap into the ESG wave without feeling overwhelmed, confused, or pressured. That means exploring the actual tools, platforms, account types, and investment vehicles that make ESG simple. The practical side of ESG investing starts with understanding that you don't need a Wall Street background to navigate this space. In fact, the biggest misconception is that ESG is only for people who spend their weekends reading corporate sustainability reports or decoding climate risk disclosures. The truth is far simpler. ESG investing has already been packaged in ways that make it almost plug and play for everyday individuals. The difficulty isn't in access, it's in recognizing the options that already exist right in front of you. Consider the average person who opens a brokerage app for the first time. They're met with charts, numbers, tickers, lists of ETFs, and more acronyms than they ever asked for. So naturally, most people either pick random stocks they've heard about or ignore the platform altogether. But ESG investing fits neatly into the same tools people are already using, often with clearer explanations and more curated selections than traditional stock picking. That's because, unlike picking individual stocks, which requires deep analysis and constant monitoring, many ESG products are built specifically to reduce complexity for beginners. One of the simplest gateways into ESG for regular Americans is the ESG ETF. ETFs, exchange-traded funds, are essentially baskets of stocks grouped together. When you buy an ETF, you're buying a tiny piece of every company inside that basket. ESG ETFs work the same way, except the companies included in the basket meet certain environmental, social, or governance criteria. This makes ESG ETFs both diversified and curated. You're spreading your risk across multiple companies while avoiding businesses that don't meet the ESG standards defined by the fund. You might wonder, who decides the standards? That's where professional fund managers come in. They analyze companies based on their ESG performance, sometimes using outside rating agencies, and then assemble a portfolio accordingly. That means the heavy lifting is done by analysts with access to information, tools, and expertise that the average person simply doesn't have. And because ETFs trade like stocks, you can buy them with a few taps on your phone, often for low fees and with small amounts of money. To make this even more accessible, many ESG ETFs focus on different themes. Some highlight clean energy. Others focus on companies with strong worker protections. Some emphasize governance and leadership transparency. Some aim to track broad indexes like the S&P 500, while excluding companies with poor ESG performance. This variety allows everyday Americans to pick investments aligned with their preferences without needing to be experts. But ETFs aren't the only entry point. Mutual funds, which operate similarly to ETFs but trade differently, also offer ESG-focused options. These are often available inside 401ks and IRAs. That means you might already have access to ESG investments inside your retirement account without realizing it. In many workplace retirement plans, ESG options appear in the fund lineup next to traditional target date funds or index funds. People often skip over them simply because they don't recognize the names or don't know what ESG means. The funny part is that many employees assume their retirement plan is locked into a specific set of funds chosen by their employer. But within those menus, there is often at least one ESG-focused fund designed for people who want long-term growth while minimizing exposure to companies with high environmental or social risks. Because these funds are built for retirement accounts, they tend to be well diversified and professionally managed, which can make them more stable and easier to understand than picking individual stocks. Beyond ETFs and mutual funds, another practical tool for ESG investing is the automated investing platform, the robo-advisor. Platforms like Betterment, Wealthfront, and others introduced ESG portfolios specifically for investors who want a hands-off approach. These portfolios automatically allocate your money into ESG-screened ETFs based on your risk tolerance. You answer a few questions, and the platform does the rest. This removes the intimidation factor and makes ESG investing almost effortless. You don't have to choose specific funds or track ESG metrics yourself. The robo-advisor optimizes and rebalances the portfolio for you. And yet, even with all these accessible tools, many people feel hesitant. They worry they'll make the wrong choice or that ESG investing requires a level of moral or environmental knowledge they don't have. But again, ESG is fundamentally about risk management and long-term efficiency, not about being perfect or ideological. Investors don't need to know everything about carbon emissions or board diversity. The entire purpose of ESG screeners, fund managers, and automated portfolios is to help filter that information so everyday Americans don't have to. But for those who do want a bit more hands-on control, ESG investing can still be simple to approach. For example, understanding ESG ratings can help investors get a quick snapshot of a company's responsibility and sustainability practices. These ratings come from organizations that analyze data in environmental impact, labor practices, governance structures, and more. Just like credit scores condense complex financial behavior into a single number, ESG ratings condense a company's non-financial performance. However, these ratings vary by provider because each one weights factors differently. One agency might prioritize environmental performance above all else, while another might put more importance on governance. This inconsistency sometimes confuses beginners, but it's actually an advantage. It means investors can look at multiple scores to get a more well-rounded picture instead of relying on one organization's assessment. And in many cases, brokerage apps conveniently display ESG ratings right on the company's profile page, making it easy to compare companies without deep research. Now let's talk about something that matters even more than access: mindset. Investing, ESG or otherwise, isn't just about picking assets. It's about understanding your goals and choosing a strategy that fits your situation. The biggest mistake beginners make is assuming that investing requires predicting the future or finding the perfect investment. But even seasoned professionals can't predict markets with absolute certainty. Instead, successful investors think in terms of strategy, time horizon, and risk alignment. ESG helps with this because it inherently focuses on long-term considerations. Companies with strong environmental practices are better prepared for regulations and resource shortages. Companies with strong social practices have more loyal employees and customers. Companies with strong governance face fewer scandals. Long-term investors benefit from these factors because they reduce volatility, protect against major disruptions, and support more stable growth. So without even trying, an ESG investor often ends up adopting a long-term mindset simply because ESG companies are tended to be built for long-term stability. And another major advantage for everyday Americans is that ESG investing aligns with trends that are shaping global markets. Renewable energy, electric vehicles, sustainable agriculture, waste reduction technologies, ethical supply chains, diversity initiatives, cybersecurity practices, and responsible governance are all becoming more central to how companies operate. This doesn't mean every ESG trend will produce huge returns, but it does mean that many industries considered ESG-friendly are also industries driving future innovation. In other words, ESG investing sometimes overlaps with technological megatrends, the shift toward cleaner energy, smarter infrastructure, and more transparent corporate behavior. That means a person who invests in ESG isn't just making a values-based decision, they're often tapping into sectors with high growth potential. Of course, it's important to discuss the downsides and risks as well, because every investment strategy has them. One risk is overconcentration. Some ESG funds focus too heavily on certain sectors, like technology or clean energy. If those sectors underperform, the fund might lag behind broader indexes. Another risk is greenwashing, where companies exaggerate their commitment to sustainability to attract ESG investors. This can mislead people unless the fund managers or platforms conducting the screening are rigorous.
There's also the issue of performance. While many ESG funds perform competitively with or better than traditional funds, performance varies. Some ESG products charge higher fees, which can eat into returns over time. And because ESG becomes a popular marketing tool, some funds include companies that look good on paper but don't necessarily perform better financially. This is why research is important. Not deep corporate research, but simple, high-level checking. Look at the fund's expense ratio. Look at the sectors it includes. Look at its historical performance. Look at how consistent its ESG criteria are. These small steps can help everyday Americans avoid poorly structured ESG products while still accessing the benefits of the approach. Another point worth mentioning is that ESG investing is not an all-or-nothing choice. You don't have to switch your entire portfolio to ESG investments. You can simply include ESG funds as part of your broader mix. Many investors choose a core index fund for stability and then add ESG funds to express preferences or access growth areas. This hybrid approach offers the best of both worlds, diversification and intentionality. It also allows beginners to start small. You can invest $10 or $20 into an ESG ETF without needing to commit your entire strategy to ESG. Over time, as you learn more and become more comfortable, you can increase your allocation. This low-pressure approach makes ESG a flexible tool instead of a rigid rule. And flexibility matters because every investor's situation is different. A college student starting their first investment account has a different risk tolerance than a parent saving for their child's future or a retiree managing withdrawals. ESG investing can adapt to all these situations because its principles, risk management, long-term resilience, quality leadership, apply across age groups and wealth levels. For students or young professionals with limited funds, ESG ETFs provide an inexpensive way to invest in responsible companies without needing expertise. For families, ESG investing can align with personal values while still focusing on growth. For retirees, ESG funds that emphasize strong governance and risk management can provide stability during uncertain markets. As more people participate in ESG investing, something interesting happens. Companies respond. When investors reward sustainable and well-governed companies with higher valuations, other companies take notice. They begin improving practices, not out of ideology, but out of competitive necessity. In this way, everyday investors play a quiet but powerful role in shaping the future of business. And all of this leads to a simple realization. ESG investing isn't just about choosing stocks. It's about choosing the direction you want your money to move. It's about aligning financial goals with broader trends. It's about participating in markets not as a passive observer, but as someone making informed decisions. Now that we've covered the investment tools and strategies available to everyday Americans, the next step is diving deeper into how to evaluate ESG products effectively, what to look for, what to avoid, and how to build confidence when choosing ESG investments. Evaluating ESG investments doesn't require investors to become analysts or financial detectives. What it does require is a simple framework, something clear, practical, and easy for everyday Americans to apply without getting lost in technical jargon. The truth is you don't need to dive into dense sustainability reports or decode complex corporate governance structures. Instead, the key is knowing what signals to look for. These signals help you separate strong ESG investments from those that simply wear the ESG label as a marketing badge. The first and most important signal is transparency. Transparency is the foundation of any credible ESG investment. If a fund is genuinely committed to ESG principles, it will clearly explain how it chooses companies and what criteria it uses. This information shouldn't be hidden in obscure documents. It should be easy to find, easy to read, and easy to understand. A fund that says it invests in sustainable companies without showing how it defines sustainability is simply asking you to trust their word. But investing isn't about blind trust, it's about informed decisions. That's why transparency matters. A strong ESG fund will typically provide details about its screening process. It might explain, for example, that companies must meet certain emissions criteria, maintain specific labor standards, or demonstrate board independence. These explanations don't have to be technical, they just need to be specific. If a fund can clearly articulate its ESG standards, that's a positive sign. If it cannot, it may be taking shortcuts, including companies that don't align with ESG principles. The second signal is consistency. An ESG fund should apply its standards consistently across all companies it includes. One of the biggest criticisms of ESG investing is inconsistency. Some funds exclude oil companies, while others include them as long as they show improvement in certain areas. Neither approach is inherently wrong, but inconsistency is. If a fund claims to avoid companies with high environmental impact, but then includes firms with poor environmental records, that's a red flag. Consistency shows that the fund takes its criteria seriously. How can everyday investors check consistency? You don't need special tools. Simply review a few of the top holdings in the fund. If the companies seem aligned with the fund's stated ESG principles, that's a good sign. If you find companies that don't fit the description, take a closer look. Sometimes there's a rationale, maybe the company is transitioning towards more sustainable practices. Other times the inconsistency reveals weaknesses in the fund's screening process. The third signal is performance, both financial performance and ESG performance. Let's talk about financial performance first. ESG funds, like all funds, should be evaluated based on returns over time. But returns alone don't tell the whole story. You also want to consider volatility, expense ratios, and long-term stability. Some ESG funds perform exceptionally well. Others lag behind because of poor construction or high fees. Always compare an ESG fund's performance to a similar non-ESG fund. For example, if you're looking at an ESG version of an S&P 500 index fund, compare it to a regular S&P 500 fund. If the ESG version charges higher fees but delivers similar or lower returns, you need to decide if the ESG alignment outweighs the additional cost. Then there's ESG performance itself. Does the fund actually push companies toward better practices, or does it simply invest in companies that already look good on paper? Some funds engage directly with companies. They vote on shareholder proposals, influence corporate policies, and advocate for improvements. Others take a passive approach. For everyday investors, it's not always easy to see this activity, but many funds publish reports summarizing their engagement efforts. Funds that actively hold companies accountable often deliver stronger long-term results because they're influencing real change. The fourth signal is diversification. An ESG fund should offer broad exposure across sectors and industries. If an ESG fund invests too heavily in one area, like clean energy or tech, it might be more volatile. There's nothing wrong with themed ESG funds, but beginners should be cautious. A diversified ESG fund spreads risk across multiple sectors, reducing vulnerability if one industry underperforms. Look for funds with exposure to companies in different fields, such as healthcare, consumer goods, finance, manufacturing, and technology. Diversity helps create balance. The fifth signal is authenticity. Authentic ESG funds don't just slap ESG on the label, they integrate ESG principles into the investment process. Authenticity can be seen in how the managers communicate. Do they publish ESG reports? Do they explain why companies were added or removed from the fund? Do they highlight improvements companies have made? Authentic investors treat ESG metrics the same way they treat financial metrics, as essential to decision-making. Authenticity often becomes clear once you've reviewed the fund's materials for a few minutes. But what about evaluating individual ESG stocks? Not everyone will want to stick exclusively to funds. Some investors enjoy choosing individual companies that align with their goals. For those individuals, the evaluation process is similar. Look for transparency, consistency, performance, diversification within the company's operations, and authenticity. Start with transparency. Does the company report its environmental impact? Does it publish diversity statistics? Does it explain board structure or risk management practices? Many major companies now publish ESG reports or sustainability reports annually. If a company refuses to disclose basic ESG information, that may be a warning sign. Then consider consistency. Does the company follow through on its commitments? Has it set measurable goals, such as reducing emissions by a certain percentage or increasing board diversity? And has it made progress? Companies that set goals but never achieve them may be more interested in public relations than actual improvement.
Next, review financial performance. Strong ESG practices are valuable only if the company's financial fundamentals are solid. You want a company that is both responsible and profitable, or at least positioned for profitability. A company with excellent ESG practices but poor financial management may not be a wise investment. When evaluating individual ESG stocks, also consider industry context. A technology company and a manufacturing company face very different ESG challenges. You can't judge them using the same criteria. For example, a tech company's environmental impact might be lower than that of a steel company, but the tech company's social responsibilities, such as data privacy, are more complex. Understanding these differences helps you make fair comparisons. For investors who want a hands-off approach, robo-advisors and pre-built ESG portfolios simplify all of this. These platforms handle screening, diversification, and rebalancing for you. But even with automated tools, understanding the fundamentals helps you choose the right platform and the right level of risk. Now let's go deeper into something that's often overlooked: the emotional and psychological benefits of ESG investing. Many people underestimate how their emotions influence their financial decisions. Fear, hesitation, impatience, and uncertainty often lead people to make choices that hurt their long-term growth. ESG investing can help counter these tendencies by introducing a sense of purpose. When investors feel connected to their investments, when they understand why a company is chosen and what it represents, they are less likely to panic during market downturns. They're more likely to stay consistent with their strategy. This matters because one of the biggest factors in long-term investment success is simply sticking with it. Investors who panic and sell during market dips often miss the recoveries that follow. ESG investing also encourages patience. Many ESG themes, renewable energy, ethical supply chains, responsible governance, are long-term trends. They don't play out overnight. This naturally nudges investors toward long-term thinking, which is often where the best returns occur. Long-term investors benefit from compounding, reduced trading costs, and fewer emotional decisions. Another psychological benefit comes from the understanding that your money aligns with your preferences. Even small investors feel a sense of agency knowing they're supporting companies that operate responsibly. This isn't about being perfect or making moral statements. It's about knowing your investments reflect what you consider sustainable, stable, or forward-thinking. But ESG investing isn't just about personal satisfaction, it's about resilience. Companies with strong risk management practices tend to weather crises better. During economic uncertainty, companies that treat employees well retain talent. Companies with strong governance avoid scandals that destroy shareholder value. Companies that manage environmental risks mitigate operational disruptions. This resilience is one of the most compelling financial reasons for ESG investing. Still, it's important to acknowledge that ESG investing, like all investing, carries risks. Some ESG sectors may grow rapidly but also fluctuate heavily. Some companies may overstate their progress. Some funds may charge higher fees than necessary. That's why a balanced approach is essential. Consider blending ESG funds with broad index funds, maintaining an emergency fund, and staying diversified across sectors. Let's now expand the conversation to something rarely discussed: the ripple effects of ESG investing in local communities. When everyday Americans invest in ESG funds, they indirectly support companies working toward cleaner energy, ethical labor practices, inclusive hiring, sustainable agriculture, and responsible governance. These efforts create real-world impacts: reduced pollution, safer workplaces, improved product quality, and more transparent corporate behavior. For example, a company that invests in cleaner manufacturing may reduce pollutants in local air or water. A company that commits to fair labor standards might improve the quality of life for workers and their families. A company with robust data security protects millions of customers from breaches. When investors reward these companies with capital, they encourage more companies to follow suit. This creates a cycle where responsible behavior becomes not only ethical but economically advantageous. This brings us to a common misconception: that ESG investing requires investors to sacrifice returns. Data shows that's not universally true. Many ESG funds perform just as well, if not better, than traditional funds. When companies operate efficiently, reduce risk exposure, and improve governance, they often create stronger long-term value. ESG isn't about trading profit for principles. It's about identifying companies whose sustainability practices enhance their stability and competitive edge. For everyday Americans, this is a powerful realization. You don't have to choose between financial growth and responsible investing. You can pursue both simultaneously. ESG investing isn't a special category. It's simply another layer of analysis that helps identify companies likely to thrive in a world where sustainability, accountability, and efficiency matter more than ever. As we move forward, understanding how to actually build an ESG portfolio, one that fits your goals, risk tolerance, and time horizon, becomes the next critical step. That's where things become even more practical. Allocating your investments, choosing between funds and individual stocks, rebalancing, and adapting as markets evolve. Building an ESG-focused portfolio doesn't require complexity, a financial degree, or hours spent analyzing charts. What it requires is a structure, a simple way to organize your decisions so each step feels manageable rather than overwhelming. The reality is that most people don't fail at investing because they choose the wrong asset. They fail because they never create a plan at all. ESG investing becomes far more effective when you follow a framework that guides your choices, protects you from emotional decisions, and keeps your strategy aligned with your long-term goals. A good starting point is understanding your objective. Before choosing a single fund or stock, ask yourself what you want your investments to accomplish. Are you aiming for long-term growth over decades? Are you hoping to preserve wealth with lower volatility? Are you looking for steady income through dividends? Or are you building a blend of growth and stability? Your goal dictates how aggressive or conservative your ESG portfolio should be. For example, someone in their early 20s with a long time horizon might choose ESG investments with higher growth potential, funds focused on innovative clean energy companies or technology firms prioritizing governance excellence. Meanwhile, someone approaching retirement might prefer ESG funds with stable, well-established companies demonstrating strong governance and risk management. When you know your goal, you can select the ESG investments that fit rather than relying on guesswork. Once your objective is clear, the next step is defining your risk tolerance. Risk tolerance isn't just about how much volatility you think you can handle, it's about how much volatility you can handle without making impulsive decisions. People often assume they are comfortable with risk until the market drops 20% and they panic. That's why it helps to think in practical terms. If your portfolio dropped by 15%, would you stay calm? Would you buy more? Or would you feel anxious enough to sell? Your honest answer influences how your ESG portfolio should be weighted. With your objective and risk tolerance defined, you can move into actual portfolio construction. A balanced ESG portfolio typically includes a mix of the following: ESG index funds, ESG ETFs, themed ESG funds, traditional index funds, individual ESG compliant stocks, which is optional, and cash or bonds for stability. Let's break each one down. ESG index funds form the backbone of many ESG portfolios. They track large groups of ESG-screened companies, offering stability and broad exposure. Because index funds rarely have high fees, they're an efficient way for everyday Americans to invest responsibly without paying a premium. A well-constructed ESG index fund gives you instant diversification across hundreds of companies meeting ESG standards. This creates a strong foundation that doesn't require constant monitoring. ESG ETFs function similarly but with more variety. Some track broad ESG indexes, while others focus on specific themes. For most beginners, broad ESG ETFs are the simplest choice. They minimize volatility and reduce the need to evaluate individual companies. For more experienced investors, themed ESG ETFs create opportunities to invest in sectors aligned with their interests, like renewable energy, sustainable agriculture, water conservation, or social impact. Themed funds can be powerful, but they also tend to be more volatile, which means they're best used as a smaller portion of the portfolio.
Traditional index funds still have a place in many ESG portfolios. Some investors assume ESG means excluding anything non-ESG, but that's not necessary. ESG is a layer, not a wall. A strong core S&P 500 index fund or total market fund can complement ESG holdings by adding stability and broad exposure.
This helps avoid over-concentration in specific ESG sectors, especially tech-heavy or clean energy-heavy funds. ESG and traditional funds can coexist, creating a portfolio that is both diversified and aligned with your preferences. Then there are individual stocks. These are optional but appealing to investors who want more control. Choosing individual ESG stocks allows you to support companies whose mission aligns with your values while pursuing long-term growth. But individual stocks require deeper research and monitoring, so they work best for investors who enjoy following specific companies. When selecting ESG stocks, it's wise to focus on companies with consistent ESG reporting, strong governance, and a track record of operational efficiency. Diversifying across several industries is also essential. No single company, no matter how strong, should define your entire strategy. Lastly, cash and bonds provide stability, especially for conservative investors or those nearing retirement. ESG bonds, sometimes called green bonds or sustainability bonds, are becoming more common. These bonds fund environmentally or socially beneficial projects. While ESG bonds don't always yield higher returns than traditional bonds, they do give investors a way to support impactful initiatives without taking on excessive risk. Including bonds in your portfolio helps reduce volatility during market downturns. Now that we've identified the building blocks, the next step is determining the right allocation, how much of each asset you should include. Allocations vary depending on risk tolerance. An aggressive ESG portfolio might include 80% stocks, a mix of ESG index funds, ETFs, and themed funds, and 20% bonds or cash. A balanced portfolio may choose a 60-40 split. A conservative one might prioritize bonds and stable ESG funds while keeping only a modest portion in themed ESG investments. The key is keeping allocations consistent with your goal. For example, if your aim is long-term growth, a heavy stock mix makes sense. Just ensure it's diversified. If your goal is capital preservation, a higher bond allocation reduces risk. But building your portfolio is only part of the process. Maintaining it is equally important. This is where rebalancing comes into play. Rebalancing means adjusting your portfolio periodically to return it to your target allocation. For example, if your ESG growth fund outperforms everything else and grows from 30% of your portfolio to 40%, your exposure to that sector has become more risky. Rebalancing brings that 40% back down to your planned 30% by selling some shares or adding money to other areas. Rebalancing prevents your portfolio from drifting too far into risky territory and protects your long-term goals. Most experts recommend rebalancing every 6 to 12 months. Some robo-advisors and automated portfolios do this for you, which is helpful for those who prefer a hands-off approach. Rebalancing doesn't require constant attention, it just requires consistency. It's one of the simplest habits that contributes to long-term success. Another important element of managing an ESG portfolio is tracking progress. Tracking doesn't mean checking your investments every day. That can create anxiety and lead to emotional decisions. Instead, think in terms of quarterly or semi-annual check-ins. During these check-ins, look at performance, evaluate whether your allocation is still aligned with your goals, and make note of any changes in the ESG landscape. For example, if a major company in your fund has experienced a governance scandal, the fund may rebalance or you may choose to shift your allocation. Tracking is also useful for understanding how your ESG investments contribute to trends. Over time, you might notice that certain ESG sectors, like renewable energy or sustainability-focused tech, grow rapidly. This doesn't mean you should chase performance, but it does help you understand whether your portfolio is aligned with emerging opportunities. Now let's address one of the most common concerns. What happens during a market downturn? ESG portfolios, like all portfolios, can decline during bear markets. But historically, companies with strong governance and risk management tend to be more resilient. They recover faster, maintain investor trust, and make fewer costly mistakes. During uncertain times, ESG factors, especially governance, become more important. That's because companies that are well managed often have contingency plans, diversified supply chains, and healthy internal cultures. These strengths matter most when the economy faces pressure. Still, investors should be prepared for fluctuations.
The goal is not to avoid risk entirely, it's to manage it intelligently. Setting realistic expectations helps remove fear when markets become volatile. Instead of seeing downturns as threats, long-term ESG investors see them as opportunities to add more shares at lower prices. This mindset separates successful investors from those who panic. In addition to market volatility, it's important to remain aware of broader economic shifts that impact ESG sectors. For example, changes in government regulations can influence renewable energy stocks. Technological breakthroughs can accelerate growth in sustainable industries. Consumer trends can shift demand toward ethical products. These forces create both challenges and opportunities. Understanding these dynamics helps you make informed adjustments. For instance, when renewable energy becomes more cost-efficient, ESG portfolios with clean energy exposure can benefit. When public sentiment shifts toward corporate accountability, governance-focused funds may outperform. ESG investing aligns closely with societal and technological trends, making it especially dynamic. Another valuable habit is reviewing your ESG criteria periodically. Your preferences may evolve over time. Maybe you start with environmental priorities, but later decide governance matters more. Maybe you start with broad ESG funds, but eventually want to add themed exposure. ESG investing isn't rigid. It adapts to you. One more factor to consider is tax efficiency. Tax-efficient investing helps maximize long-term returns. Many brokerage platforms offer tax-advantaged accounts, such as IRAs or Roth IRAs, where gains grow tax-free or tax-deferred. Holding ESG investments in these accounts can amplify your long-term results. Tax loss harvesting, automatically selling losing investments to offset gains, is another strategy some automated platforms use to optimize taxes. While taxes shouldn't dictate your entire strategy, being aware of them is beneficial. Finally, the process of building and managing an ESG portfolio becomes easier when you simplify your approach. Investing doesn't need to feel like a puzzle with endless pieces. Sometimes the most effective portfolios are the most simple ones, those built on clear goals, diversified funds, and consistent habits. ESG investing doesn't require you to monitor every news headline or corporate report. It requires understanding what you value, choosing investments aligned with those values, and maintaining a steady strategy over time. Now that we've explored how to build and manage an ESG portfolio, the next piece involves understanding how ESG investing shapes broader financial trends and where everyday Americans fit into the future of sustainable investing. As ESG investing continues to evolve, it's becoming clear that this isn't just a trend, it's a fundamental shift in how markets operate. More companies are recognizing that environmental stewardship, social responsibility, and strong governance aren't optional extras. They're key components of long-term financial stability. And as more investors prioritize these factors, companies are adjusting their practices to stay competitive. This shift creates a feedback loop. Investor demand encourages better corporate behavior, and improved corporate behavior attracts more investment. For everyday Americans, this means the financial landscape they're stepping into today is vastly different from the one their parents or grandparents experienced. The old assumption that ethical investing requires sacrificing profits has been challenged repeatedly. Instead, data increasingly shows that companies with strong ESG scores tend to be more resilient, manage risks better, and adapt more quickly to global changes. When a company prepares for the future, whether through innovation, efficient resource management, or fair labor practices, it places itself in a position to survive disruption and capitalize on opportunity. This advantage becomes even more obvious during moments of global transition. Consider the energy sector. For decades, it was dominated by fossil fuels. But as the world shifts toward renewable energy and cleaner technologies, companies that innovate rather than resist are capturing the growth. This doesn't mean that every sustainable energy company will outperform traditional energy stocks, but it does highlight the importance of aligning with long-term trends rather than short-term noise.
ESG investing helps position investors ahead of these trends. Instead of reacting after a major shift occurs, ESG investors often find themselves participating in sectors that are gaining relevance. Industries like clean energy, sustainable agriculture, ethical manufacturing, and efficient transportation are not fringe or speculative. They're rapidly becoming central pillars of the global economy.
Governments around the world are supporting these industries through incentives. Companies are investing billions into innovation, and consumer demand is pushing markets in the same direction. But ESG investing isn't only about future trends. It's also about reducing exposure to risks that could damage a company's value over time. Environmental risks such as resource scarcity, pollution liabilities, and climate-related disruptions can have major financial consequences. Companies that ignore these risks may see increased operational costs or face regulatory penalties. On the social side, poor labor practices, discrimination issues, or unsafe work environments can lead to lawsuits, employee turnover, and reputational harm. Governance failures like fraud, corruption, or poor oversight have caused some of the most catastrophic corporate collapses in history. When you invest with ESG in mind, you're not just pursuing companies that do good, you're avoiding companies that are structurally vulnerable. This risk reduction matters when you're building long-term wealth. Even if you never think about ESG as a value-driven strategy, it still functions as a risk management strategy. It helps you tilt your portfolio toward companies that are better prepared for economic, social, and regulatory challenges. It's also important to understand that ESG investing isn't about perfection. No company is flawless, and no investment is immune from risk. The goal is progress, not purity. ESG ratings, reports, and metrics are tools to help investors make better decisions, not to declare moral superiority. An investor can build a meaningful ESG portfolio without eliminating every company that operates in a controversial sector. What matters is intentionality, choosing investments that align with your goals and values while still pursuing financial growth. As ESG investing grows, we're also seeing more transparency. Companies are being pushed to report sustainability efforts, emissions, labor practices, and board diversity more thoroughly than ever before. While some companies may try to exaggerate their ESG performance, increased scrutiny makes this harder over time. Independent evaluators now track corporate claims, and investors demand accountability. Over the next decade, ESG reporting is expected to become even more standardized, giving everyday investors clearer information to work with. Another shift influencing the ESG landscape is generational change. Younger investors, particularly millennials and Generation Z, show stronger preference for sustainable investing than previous generations. They want portfolios that reflect their values, and many believe capital can be used as a tool for positive change. As trillions of dollars transfer from older generations to younger ones, ESG investing is projected to become an even larger portion of global assets. This has major implications for markets. When a large demographic demands ESG-focused investments, companies must adapt or risk losing investor support. That adaptation can manifest in numerous ways: improved energy efficiency, better employee policies, more diverse leadership, or increased transparency. Even if someone has no personal interest in sustainability, they can still benefit financially from investing in companies that stay competitive in a shifting marketplace. It's also worth recognizing that ESG investing supports innovation. Many industries driving progress, electric vehicles, renewable energy storage, green infrastructure, sustainable housing, and ethical AI, benefit from ESG-driven capital. When investors support these industries, they help accelerate solutions that can improve lives and strengthen economies. Investing isn't just about buying stocks, it's about shaping the future. However, as ESG grows, misinformation can spread. Some people oversell ESG as a guaranteed path to outperformance, while others dismiss it as meaningless or politically motivated. The truth lies in the middle. ESG investing is neither a guaranteed strategy nor a passing fad. It is a practical, risk-aware, forward-looking approach to investing that recognizes the connection between responsible corporate behavior and long-term performance. For everyday Americans, the most important takeaway is that ESG investing is accessible. You don't need a large budget, extensive knowledge, or advanced tools. Most major brokerage platforms offer ESG fund selections, screeners, and research tools. The process can be as simple as choosing one or two diversified ESG index funds and adding them to your portfolio. If you want to go deeper over time, you can explore themed funds, individual stocks, or green bonds. Your journey doesn't need to begin with complexity. It can grow with you as you learn. One of the biggest advantages of ESG investing is that it aligns financial growth with personal beliefs. For many people, this makes investing more engaging. When you feel connected to the companies you invest in, you're more likely to stay committed to your long-term plan. And long-term commitment is one of the most important predictors of investment success. Markets go up and down, but staying consistent through those cycles creates the greatest potential for wealth building. In addition, ESG investing helps combat the idea that the market is uncontrollable. It reframes investing as something purposeful. Instead of feeling powerless in the face of economic uncertainty, ESG investors feel they're contributing to the progress they want to see. That mindset makes the process more sustainable, financially and emotionally. Everyday Americans face enough financial stress as it is. Between rising living costs, unpredictable markets, and constant news cycles, it's easy to feel overwhelmed. ESG investing offers clarity. It gives investors a framework to filter out noise, focus on companies that prioritize long-term stability, and invest in industries that reflect where the world is headed. As we close this video, one message becomes clear. The future of investing belongs to those who invest with intention. ESG investing isn't about choosing between values and returns, it's about combining them to create a strategy that supports your financial goals while contributing to meaningful progress. Your portfolio becomes more than a collection of numbers. It becomes a reflection of what you believe in, a tool for building wealth, and a way to participate in shaping the future. And while no strategy eliminates risk, ESG investing gives you a roadmap, a way to build, maintain, and grow a portfolio rooted in resilience, responsibility, and opportunity. The more you learn and the more intentionally you invest, the more confident you become. Over time, this confidence turns into momentum, and momentum turns into long-term financial strength. If you've been considering ESG investing, now is a powerful time to begin. Whether you start small or dive deeper, what matters is taking the first step towards a more informed, strategic, and sustainable financial future.